you're going to have a lot of money there. And then eventually you can borrow against it. That's what's going to happen down the road. But you got to clean up or plug the leaky holes in your bucket before you can move forward.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
All right, everybody, welcome to another episode of the Alternative Investor Mastermind. I'm your host, Jack Krupe, and I've got two amazing guests today, Julie Weiss and Tim Yurek. I've known Julie for a few years through various mastermind groups, and her company is Wealth Lake Ventures, and got to know Tim Yurek over the last month or two, and he has a company named Tier 1 Capital. So without further ado, Julie, why don't you start us off? Just tell us a little bit about your background and how you've got involved with Tim and his firm.
Sure. Yeah. So I'll go back a little bit. Back in the 90s, I was a financial advisor for about 5 years and chose not to stay in that field. And essentially, fast forward, I worked in a lot of corporate 100, Fortune 100 companies throughout the Midwest. And about 13 years ago, moved to Arizona, where I met my business partner, Nicole. About 5 years ago, we started in the multifamily arena and then transitioned into capital raising, which is how I met you, Jack. Nicole and I met you through some capital raising masterminds. So throughout our journey, about 5 years ago, we heard about this great thing called infinite banking. And we got the book from Nelson Nash. Somebody gave it to us, and it laid on our table for, I think, probably 2 years. And then we went to a conference and we heard about infinite banking again. And so this time we were paying attention, and we actually made some referrals to a company that we were familiar with. And then probably it was like last summer, we were at an event and someone mentioned infinite banking again. So we contacted this person and their company and just started asking more and more questions and got really, really into it. So February of this year, we attended the Nelson Nash Institute conference, which was held in Vegas. And at that meeting, or at that conference, we met Tim Yurek. And Tim is, we'll learn a little bit more about him here real soon, but we just instantly connected with Tim and his daughter, who also has worked with him for about 10 years. And that's the story of how I met Tim. And so if you want, I can go right into more about Tim.
Yeah, absolutely. Or and then obviously Tim, we'll let Tim speak at some point as well.
Okay. So I'll just keep going. So then fast forward to meeting Tim, one of the conversations that Nicole and I had as business partners is, what are we going to do? Are we also, in addition to capital raising, this infinite banking is definitely something that we want to look more into when it comes to from a family perspective, as we started to listen and learn more, and also a business perspective. We run an independent business on our own. We know the challenges of being an entrepreneur. And so once we started learning more about this and talking to Tim, it just became more evident that we needed to start our own agency. So that's what we did. Hence Wealth Lake Ventures, which is the name of our infinite banking arm and our investment arm as well. So, we're going to start educating a little bit more on money, infinite banking, kind of the whole realm of the world, alternative investments, which is why I think it's such a great to be on your podcast, Jack, because I know that's where you tend to gravitate. So we met Tim back in February, and like I said, we just instantly hit it off. And Tim was the one that actually came to us and is like, you guys have a lot of contacts and you network a lot. And one of the things that I think that would be great for you guys is to look into having your own agency. And so hence, that's what we did. And, what we really liked about Tim the most is that his conversations were not just about the IBC product. His conversations were about how are you using your money? And that really just the light bulb went off. And I'm like, yeah, how are people using their money? And Tim has like 39 plus years of experience. He'll tell you a little bit more about him and his background, but it was instantaneously, we saw the match in partnering with Tim because of all of his experience and the way in which he works and talks about money holistically from a business perspective, not just a product. That's all.
That's a great intro. And Tim, obviously I've gotten to know you a little bit, but just for the audience, maybe just kind of start from the beginning and tell your story.
Yeah, so I won't bore anybody with this, but I've been in financial services for 39 years, and I have a degree in economics. And basically, there's three ways you can go with that. You can go into the banking industry, the investment industry, the Wall Street model, or insurance. And I was advised by a close family friend to get involved in the insurance side because it's more relationship oriented, and I'm a relationship oriented person. Banking and investments at the time seemed to be more transactional. And so I took that path, and lo and behold, what I never saw coming was that the three industries would converge. And if you remember back in probably like the mid to late 80s, there was a one-stop shopping type financial services firms sprouting up all over. There used to be a firewall between insurance and banking and investments, investments and banking and insurance, and banking and insurance and investments. And then all of a sudden those firewalls came down with basically the repeal or the watering down of Glass-Steagall. And consequently, what happened was all three industries were allowed to do all three. And I felt that I had a bit of an advantage because the other two industries were transactional, and now they're coming into a relationship-oriented situation. And so, lo and behold, I'm involved in financial services. And now I'm recommending and also following myself the advice that the industry was peddling. And I was doing very well. I started in 85, and by 1993, I'm in the top 5% of, producers in the industry. And literally, I'm living pay to pay. I'm broke. And the troublesome thing about that, Jack, was I was implementing the same advice I was giving. And if I was broke, I was putting my clients in a bad situation. And that was troubling to me. And finally, in December of 1993, the light bulb went off when I was at Christmas dinner at my parents' house, and we were talking about the good old days. And, we came from very, very humble background. And, we used to go and get my dad's pay every once in a while when he would come home from work without it. And we would literally wait in front of the boss's house until he came home and then get my dad's pay. Well, one time the car didn't start. And as a kid, and I'm thinking, Jack, I was probably like 8, 9, 10 years old. That was very embarrassing. And so we had to get our car towed. And so we're talking about this in 1993, reminiscing about the good old days. And I just remember saying to my mom, what were we doing there? And she said, well, we were waiting for Daddy's pay. And I said, why don't you just wait till the next day? And I'll never forget the look that she shot me. And she said, honey, we lived pay to pay. If I didn't have that pay that night, we were going to, they were going to turn off the gas or the electricity or the phone or something. And that's when the epiphany I had was, because I'm sitting there saying, oh my God, I'm living pay to pay. This is where I am right now. Now, we've been conditioned to believe the reason we're living pay to pay is because we don't make enough income. That's not true. The reason we're living pay to pay is because of how we're using our money. And that was a big game changer for me, because the things we've been trained to do by the financial services industry, by large corporations, the vendors that we deal with, all of those strategies that they tell us are good for us are actually better for them. And because of that, it puts our money out of reach when we need it most. So consequently, when we need to access capital, whether it's for a financial emergency, a medical emergency, or just a business or an investment opportunity, we don't have access to our own capital. So what do? We have to go to the banks. And then once you start dealing with the banks, all of a sudden you're giving away your future cash flow, your future income. And that's never a good situation, because we have a saying: whoever controls your cash flow controls your life. And because of that, you always want to be in control of your cash flow. So in 93, I figured out some things that I was doing with my money that was separating me from my money. And I started implementing the opposite of what they were telling me to do. And lo and behold, Jack, I'm starting to sit on a huge pile of cash. Now the question becomes, well, what in the world do I do with it? Because I also want to have that money available. And then in 1997, I was very fortunate, I met a gentleman by the name of Nelson Nash. And Nelson Nash showed me the infinite banking concept. So the infinite banking concept is the tool that we use ultimately. But to get there, you need to clean up your cash flow situation. Now, I'm not talking about, go and do a budget and, tell your wife that instead of going out for three times for dinner this week, we're only going to go out 2 and we're going to save the extra $100 every week. No, I'm not talking about that. We show people how to save more money without having to reduce their lifestyle. Because as hard as it might seem to believe, the fact of the matter is the money is there in your current cash flow. It's just being used inefficiently or ineffectively. And so what we do is we try to plug, most people have a leaky bucket. They have holes in their bucket, and we just show them how to plug the holes. Well, once you plug the holes, stop doing those things that are separating you from being in control of your money. All of a sudden, now you're sitting on a lot of money. And then the next step is to save it in an area where you have complete liquidity, use, and control. Nelson Nash showed me that you don't need life insurance in order to enact or to implement the infinite banking concept. But what he did show me also was that life insurance was the best place to put your money to implement the infinite banking concept. So you don't need life insurance, but it's the best place to put it if you're going to implement the infinite banking concept. So I don't know.
Fascinating. So I'd never heard that before. Like, what else would someone do? Just acknowledging that insurance is the best. Just what else could someone do besides insurance? I've never heard that.
Yeah, it's a great question. So let's run the gamut. So there was a guy, he lived in Long Island, and he contacted Nelson Nash. And he had said, hey, I'm doing infinite banking. I don't believe in life insurance. But I'm doing it with a credit line. So you need access to capital, And then, so his access was through a business credit line. He would borrow money from the credit line, loan it to his business, and then make payments back to the credit line at a rate higher than what the bank was charging. So he's doing this, and he calls Nelson and he says, "Hey, like, you don't have the market cornered. I got this squared away." Well, as fate would have it, within a month or two of that phone conversation, Nelson Nash said, "Hey, I'm going to be up in Wilkes-Barre, Pennsylvania, presenting to Tim Yurek and his clients. I'll invite you to come to this event free. I'll spend some time with you and show you the virtues of using life insurance versus using a credit line." And lo and behold, the guy shows up. And by the time that 2-day conference was over, he left and he said, "Tim, we need to talk. Let's set up some insurance policies." So you can use a credit line. You can use a margin account, an investment account. Take a margin loan. You can use a regular savings account or a CD account. You can use your retirement account, right? Every one of these, you can use a home equity line of credit. You can use a business line of credit. It doesn't matter. You just need access to capital. Now, here's where Nelson was a genius. Because what he said was, every time you use one of these other products, one of these other depositories or sources of capital, you are not in control of the process. And this is a big game changer, because people think infinite banking is about making money by making purchases. Nothing could be further from the truth. Infinite banking is all about being in control. You're controlling the financing function in your life. And consequently, when you are in control of that financing function, it creates a different life. It creates a much better life. It creates a stress-free life. Think about that. If you knew when you were starting in business, Jack, that number one, you would never have to go begging for money to a bank or a credit facility or using credit cards or any of that stuff for access to capital or borrowing money from your family. You would never have to do that. And you would be in control of the terms and conditions of how to pay it. You see, life insurance loans, what makes them better than all the other products is the fact that life insurance loans are unstructured, meaning that the insurance company doesn't hand you a coupon booklet when you get a loan. If you ever get around to paying the loan, fine. If you don't get around to paying the loan, fine. The insurance company doesn't care because they are fully collateralized. So it's a different type of process, but it's a process that you can be in control.
That's great. I know, there's a lot of opinions on the whole infinite banking world, the whole, whole life variable rate. There's a tons of terms that I maybe know enough to be dangerous, but maybe not. But I guess to simplify it, at least what my uneducated opinion on it is I've always been skeptical of whole life. However, in the concept where you could borrow back a majority or significant amount of your money, those to me are the best policies, and that's where the power of infinite banking comes in, as opposed to what I'd call the retail policy. Often the representative makes a gigantic commission, but the money is generally locked up with not a lot of options to borrow. Is that close to correct?
It's close from the perspective, Jack, of saying in the early years, there's not a lot of money available for the traditional whole life policy. It's in the early years, there's very little, if any, cash available. think about this. Year one, you pay your premium. There's no cash in one of those traditional policies. Year two, there's no cash. Some companies, year three, there's zero cash value. And then in year four, you get like 10%, and it starts to scale up from there. The way we design policies, we design them more for cash accumulation. But let me segue into something, step back and explain something. When Nelson Nash discovered this concept, he was 51 years old. And at the time, it was 1981. And at the time, interest rates shot up. If anybody's been around long enough to know what the interest rates were in the early 80s, they shot up to like 22, 23% if you were borrowing money. It just so happened that he owned a commercial property, and it was a variable loan, and it was in the fifth year, so the amortization schedule changed, and he went from paying 8.5% to paying 23.5% overnight. And, you know, like Nelson said, when things like that happen to people, they get religion really fast. And he'd be up at 2, 3 in the morning on his knees praying, Lord, please help me find a way out of this financial prison that I've created for myself. And here was the answer. His prayer was answered. A couple days later, he got an insurance policy annual statement with a premium notice on a policy he had purchased in 1958. The premium was $389 and change. And he noticed that if he paid that premium that year, his cash value would have grown by $1,600. So every dollar he put in would grow by $4. And he realized that's the answer to my prayer. I need to get my life insurance premiums equal to my mortgage payment. And when I do that, at some point, if this ever happens again, I'm going to be covered because my cash value increase will be greater than the increase in the mortgage. So he went about buying regular life insurance policies, the traditional type that we said are no good, because the paid up additions rider, having the ability to put in extra cash, didn't exist back in 1981. So what he had to do was buy regular life insurance. He was a forward thinker. He was trained as a forester, and they think 70 years in advance. And that's what Nelson realized, that he needed to get his premiums up to that point so that if this ever happened again, he would be covered. And that's exactly what he did. And fast forward to today, it's much easier and much better because now you could design a policy for significant cash early on. And that would give you access to money. You don't have to wait 3-4 years before you have to borrow. I guess that's the point.
Yeah, that's super powerful. So I know you work a lot with business owners. Let's maybe just kind of run through a scenario or two for a successful business owner, maybe somebody who's netting, $1 million plus a year, a small mid-sized business, already, maybe they're maximizing their safe harbor 401k plan, putting 50,000 into a 401k. Maybe they have some defined benefit pension plan to lower their taxable income, and ultimately they're still sitting on a bunch of money. They're going to pay some taxes, but they've still got a pile of money to do something with. Where does infinite banking optimize that business owner?
Well, that's a great question, Jack. And here's the issue. The issue is it's all about cash flow, right? So if you're in control of the finance function, and let's face it, businesses are using finance every day. They're either borrowing money and paying a bank or a credit company for the privilege of using their money, or they're burning their cash. which is a form of finance. It's called self-finance. And what Nelson taught me was that you finance everything in life, and you have to square up the opportunity cost if you're paying cash. Because you're either going to pay money, pay interest, or give up interest if you pay cash. If you borrow, you're paying interest. If you pay cash, you're giving up interest. It's either pay up or give up. There's no way around it, except for infinite banking. So this is a passion of mine because small businesses in America, I mean, there is nothing more quintessentially American than a small family-owned business. And I don't care if it's a barber shop. I don't care if it's a pizza shop. I don't care if it's a manufacturing company. The small businesses are the heart of our economy. We commissioned a research report, and they came up and found that 44% of our overall GDP comes from what are considered small businesses. 50% of all jobs in America come from small businesses. And 90% of all companies in America are categorized as small businesses. So small businesses are the heart of our economy. But small businesses are also struggling. A recent survey by Intuit found that 61% of small business owners struggle with chronic or cyclical cash flow issues. 69% of small business owners admit to losing sleep or sleeping less due to cash flow concerns. Now, there have been multiple studies that sleep deprivation causes an increase in stress, which also causes a 200% increase in the incidence of cancer and a 20% increase in premature death. And a lot of people don't know this. Again, that same research report that we commissioned found that the average life expectancy of a small business owner is a full 5 years less than the life expectancy of the average American. But here's the irony, Jack. I have found that all of these cash flow issues are self-inflicted. It's how the company is using their money. Now, here's the other ironic part of that. No business owner would ever admit that they're using their money inefficiently. Their CFO won't allow them to do that. Their CPA or accounting firm wouldn't allow them to do that. The fact of the matter is they are. They're giving up control of their money because of how they've been trained to use it. So I have a favorite story. I was referred to this gentleman. He was a business owner. He had 4 locations to his business. And when I called him, I got referred by a very good personal friend of his. And he said, hey, Jeff's a good friend of mine. What kind of work do you do? I said, it's financial in nature. He goes, well, stop right there. I've got 2 financial advisors, and I meet with my CPA every month. If there was anything that I needed to know, these folks would have told me about it. And I said, well, listen, nobody has the market cornered on good ideas. If I can't share a good idea with you, the worst thing that's going to happen is you're a friend of Jeff's, I'm a friend of Jeff's. Each of us will make a new friend. And he said, well, come on over. So I get there. And, sure enough, Jack, this guy, he's got it pretty well locked down. He's 41 years old at the time. He owns the real estate on all 4 locations of his business. He has about $1 million set aside in retirement. Again, he's 41. He and his wife have some investments. The guy's doing pretty well. So I started asking him some questions about his debt, and sure enough, he has 2 business loans and an open credit line. And I said, were these loans taken to open up locations on your business? And he said, no, I usually pay my quarterly taxes with draws on my credit line. So then, like, I've heard this song before, and I said, well, so is this the way it works? How much are your quarterlies? He said about 50 grand. I said, so you take a $25,000 draw on the credit line, put that with your cash, you pay your quarterlies, and then you get to pay back about 25,000, and now you got to take another draw and another draw, and you just keep doing that, and the bank terms out that loan when you max out the credit line and open up another line. He goes, yeah. I said, so those two loans were to pay quarterly taxes. He said, yep. So my next question was, well, how much income do you make? And he said 650,000, which, back at that was a lot of money. And I said, when you were in college, how much income were you hoping to make? He goes, what do you mean? I said, what was your dream number as far as what you could make when you were thinking that you would be really well off financially if you could make that amount of money when you were in college? And he said, yeah, about 150, 200. And I burst out laughing. And he goes, what's so funny? And I said, isn't it ironic? You're making 3 to 4 times what you ever dreamed you could make. And you can't pay your friggin' quarterly taxes without taking a draw on your credit line. And he sort of took offense. He leaned back and he goes, well, that's just the way I do it. I said, does that make it right? And he said, well, I guess not. I said, here's the deal. If I could show you a way you would never, ever have to take a draw on your credit line ever again to pay your taxes, would that conversation be worth 45 minutes of your time? I said, absolutely. So we met. This was the summer of 2019. We put a plan together for him in October of 2019. Now, I told him it's going to take a couple years before we can get to that point. But sure enough, he filed his 2019 taxes on extension. And I got a text from him on July 8th of 2020. And he said, Tim, I just left Brian's office. Brian is his CPA. I'm happy to let you know that we had enough money set aside to pay our tax obligation for 2019. But better yet, I also have enough money set aside to pay our September quarterly, our January quarterly, and also enough for what we think we're going to owe in April for our 2020 tax obligation. Thanks for all you do for me and my family. Now, Jack, right there, if we stop right there, is that a pretty good story?
Yeah, absolutely.
It is so much better. So let's fast forward to December of 2022. We're meeting in my office. It's early December, 7 o'clock in the morning. Me, him, and his CPA. We're going to review all the stuff he had set up with me. Plus, he had now grown his business from 4 locations to 7 locations. He owns the real estate on all 7 locations. And we're looking at all the cash on hand that he has now between my accounts and each company he had a separate checking account. And when we added everything up, he's now sitting on $1.8 million of cash. Now, here's the best part of that. This guy always had the potential to be sitting on that amount of cash. He just didn't know what he was doing with his money. He was a successful businessman. He was just using his money inefficiently. And when we pointed out those areas, the leaky holes in his bucket, he just ate that up. And now think about this. He grew so we started in October of 2019, and in December of 2022, right? That's what, 26 months? In 26 months, he's sitting on almost $2 million of cash. Again, he always had that ability. But what happened was we flipped the switch with this guy. Also, keep this in mind. He opened up 3 locations. That takes capital. He was able to absorb that. He also bought a beach house for $1.5 million. That takes capital. He also remodeled that before they moved in. He remodeled the beach house. So the point is, we flipped the switch with this guy that completely changed the direction of him and his family. So that's the power, not so much of infinite banking, although that's one of the tools we use, but that's the power of taking a second look on how you're using money. And here's the great thing. We don't charge anybody to do the analysis. We do that because most people say, hey, here's the analogy I make, Jack. If I came to your house tonight and I'm sitting on your couch and I picked up one of the cushions on the couch and I found $1 under there, if I hand it back to you, you could either spend it or save it. Now, if you save it, eventually, every time I come over, if I keep finding money, you're going to have a lot of money there. And then eventually you can borrow against it. That's what's going to happen down the road. But you got to clean up or plug the leaky holes in your bucket before you can move forward. So hopefully that resonates.
Yeah, absolutely. I maybe we could go into a little more detail there. And obviously, that specific client situation, is confidential. But to have a $2 million cash flow swing like that, like what are the top couple leaks? Like what changed to grow that amount of money in that short of time?
Yeah, I'm glad you asked that. So, couple things. Number one, he was paying cash because he could. Just because you could doesn't mean it's right. So think about this. You're a business owner. You know how darn hard it is to generate a profit. So you got $1 in profit. And then what do? You go and pay cash for a vehicle. You pay cash for equipment. Why? Because you have the cash. You could burn it. You're ignoring Finance 101, which is every purchase we make has a cost. So now here's the question. How can we make that purchase, still get the car, still get the equipment, still do what we need to do with our, for our business, but how can we make that purchase and be in greater control of the money? That's where the infinite banking concept comes in. You see, again, I said this earlier, and it's so true. Infinite banking isn't about making money. Infinite banking is about being in control of the financing function. And when you're in control of the financing function, you're in control of your life. That is what it's all about.
So this is probably a good time to pivot a little bit and maybe do a little bit of a deeper dive into infinite banking. I think I've had a lot of conversations, and I think a lot of my audience is probably in the same boat as me. They've heard the concept from various places. They've probably been pitched by a number of, we call it retail, the more retail side of the business that's, not the best type of policy that generates giant commissions, but not the optimal policy for a business owner, a higher net worth, investor. So maybe we can do a deeper dive into, things to look for, pitfalls, types of plans, whether it's whole life, whether it's various other acronyms that I don't remember off the top of my head, and kind of just give a guide to somebody who's considering it, but needs to know the basics.
Well, it's funny we'll talk about that, but we have we call it our IBC Buyer's Guide, and we'd be glad to share that in the show notes. We could put a link in there in the show notes where, if people are interested, they could get a copy of our IBC Buyer's Guide, and basically it tells you the 5 things you need to consider when choosing an advisor for infinite banking. But So first and foremost, infinite banking is a process. And I think where people get really confused is that the people who are selling the insurance policies are selling the policies. They're not selling the process. And unless you have or understand the process, the policy doesn't matter. So, in other words, we've had people who are so hepped up on this, but then never use it. And quite frankly, that doesn't excite me. Like, I'm not into selling insurance just for selling insurance. I know the power of this concept because it's literally changed my life. And I see it on a daily basis of the impact that we are having on families and business owners all across the country by giving them back control of their money, their cash flow, and their life. So that's what the process is all about. So when you say do a deep dive on infinite banking, first and foremost, Jack, it is a process. And when you understand the process, then you realize, okay, we need a depository, a place to put the money. And for all the reasons I had noted earlier, life insurance happens to be the best place. Now, a specific kind, dividend paying whole life insurance issued by a mutual life insurance company. Nothing else will perform as well. Now, that being stated, keep this in mind. A life insurance policy today is only designed to earn 3.5% to 5%, depending on your age, etc. So you're not going to understand this. You're not going to get rich by owning a life insurance policy. And that's the biggest mistake that people make. They think infinite banking and owning a policy are the same thing. And quite frankly, nothing could be further from the truth. But if the life insurance is a tool, and if you utilize that tool properly, all of a sudden it could make the rest of your money, the rest of your financial decisions much better, and you'll make them with much greater clarity, because now you'll be viewing things through the lens of, am I going to be in control? And that gentleman that I told you about, who had the $1.8 million of cash on hand, that's exactly what he embraced that concept. And he said, hey, if I start making my decisions, not based on rate of return, not based on the interest rate to borrow, but if I make the decisions based on, am I in control of the process, or am I being controlled by the process? Now I'm going to be in greater control. And that's really the bottom line. So universal life, in my eyes, doesn't work. Index universal life doesn't work. Variable universal life doesn't work. All of those products are not actuarially designed the way a whole life policy is designed. And consequently, what happens is there's a lot of risk that's passed back to the policyholder with those products. There's mortality risk, there's expense risk, and there's investment risk. And all three of those risks, there's no individual in this country that is savvy enough, smart enough, and understands it well enough to take on those risks. I mean, think about it. The insurance company doesn't want, they're in the business of the law of large numbers. And if the insurance company doesn't want the risk, and they're passing the risk back to you, why in the world would you think you're better at handling that risk than the insurance company? And so that's our thought on those other products. Jack, I'm not exactly sure if I answered your question, but if I didn't, get me back on the rails here.
Yeah, no, I think it was well said. I mean, especially your point about just if they don't want the risk, how does kind of a layperson who's, not equipped to read thousands of policies of disclosures. I mean, we all get them, and I get them for mutual fund or ETFs. I get all sorts of statements. Even every time you sign up for something on the internet now, you're signing, a 20-page terms and conditions, and very few people read them. Obviously, something as important as life insurance policy is more important to read, but they're often hundreds of pages in most cases of conditions.
I have a quick story I want to share with you. I have a client who was putting over $200,000 a year into infinite banking policies. And he was approached, I want to say about 8 months ago, by somebody in a big city down in Philadelphia. I'm in the northeast part of the country. So it's about 2 hours away, Philadelphia. Some hotshot kid drives up in a sports car, and he's going to come up to northeast Pennsylvania. They look at us as a bunch of hicks. And he's coming up and he's telling my client that those whole life policies are outdated and he has a better opportunity for him and all of this garbage. And he shows him an illustration that looks to project better than what he was on track to have with the policies he had with me. By the way, all of those policies, he had 3 policies. 2 of them were 8 years old. The other one was 12 years old. And he wants to replace them with a new policy. Well, first and foremost, insurance costs more the older you are. This guy's, 8, 10, 12 years older. The mortality cost is going to be significantly greater than it was 10 years ago. So that being said, he gives him this proposal for an index universal life. So I'm sitting there with him, his CFO, and his attorney. And we're going through the illustration. And I go through all of these fancy terms and concepts that are in the illustration. And I said, do you understand what that is? No. Let's turn to the attorney. Do you understand what that is? No. And we're right down the line. We're going through this for about 5 minutes. Do you understand what that is? No. Do you understand what that is? No, I don't. Do you understand what that means? I don't. Do you understand what that means? I don't. Finally, I took the illustration, threw it on his desk. This guy was 72. And I said, Mike, let me ask you this question. Have you ever purchased anything in your life where going in, you had absolutely no idea how it worked? Have you ever purchased anything, not forget insurance, anything in your life that was this confusing and complicated going in, and you would feel good about making that purchase? He goes, no. I said, why are you thinking differently on this? And he said, I don't know. I said, well, listen, I don't know what to tell you. If you want to keep going with this, have at it. But I'm telling you, at some point in the future, if you do this, you are going to regret this. And, so far he hasn't done it. But the point is that it's so darn confusing, those other products. And they're selling you on something that may or may not happen and in all probability will not happen.
I know. I just want to add a couple things. We've come across, since being in the space of infinite banking, we've come across a couple people, at least 3 that we've talked to that currently have IULs that haven't performed as they thought they were. I think Nicole even was in something at some point that actually lost money. So what I was hearing you say actually in the past 5 to 10 minutes, Tim, is like, this is an enhancement to what you're doing. It's an enhancement to basically shifting your mindset into looking and practicing, good money. Um, how do I want to say it? Like just really taking a step back and looking how you're utilizing your money. And it's not, you're not rate shopping. A lot of times we hear like, oh, you're going to get 12% or 15% or 30% in some of these deals. But this is just a different vehicle is what I was hearing.
And that's it exactly. So it's the process first and foremost. The product is going to get you 3.5 to 5%. If interest rates go up, it might be a little higher. If interest rates go down, it might be a little lower. But at the end of the day, that's what's going to happen. But you can utilize infinite banking or your life insurance policy to make other investments, to buy alternative investments. And now you got the internal rate of return in the life insurance policy plus the external rate of return on your alternative investment. And that's where the magic really happens. Utilizing infinite banking to generate an external rate of return. And then you just rinse and repeat.
And none of us are going to give tax advice, but a lot of our focus is also on tax efficiency. So this seems like the opportune time to potentially get into some of the tax efficiencies of this as well. Tim, can you speak to that?
Yeah, for sure. So life insurance, the cash value growth, the increase in cash value is not taxed. So what that means is there's no, internal increase in taxes. Let's say you put in $10,000 a year in the policy, and the policy's now worth, and you did it for 10 years, and the policy's now worth $110,000. Well, you don't have to pay tax on that increase in, the between the value and what you've put in, your cost basis. So consequently, you could access that money on a tax-favored basis through the loan feature. So you get tax-deferred growth, you get tax-favored distribution, and then ultimately you die, and the death benefit goes tax-free to your family or your business or whomever is the beneficiary of your life insurance. So it's a really strong tax-favored vehicle. And again, I always think one of the best ways to make your money last longer is to legally avoid those taxes. And that's what, life insurance will allow you to do. Also, if you cash the policy out, again, in that example, if it was worth 110 and you put in 100, the first 100,000 that comes out is tax free because it's taxed FIFO, first in, first out, versus LIFO, like most other investments, last in, first out, meaning that you got to pay tax on the growth before you get to, drain down the principal on a tax favored basis. So there's some big tax advantages to owning life insurance. Now, if you take this to the business owner, this is really where the concept has the most attraction, because number one, it's a tax favored vehicle. Number two, it puts them in control of the financing function. Most business owners are business owners because they want to control their own destiny, because they want to be in control. And they're in control of most everything except financing. Now, when you can offer them the ability to be in control of the financing function in their business, oh my gosh, that's almost too good to be true. But then we show them how to fund the policies, maybe for business succession purposes, for exit strategy, or key person retention purposes, how to incentivize your key people to stay. And now What infinite banking allows us to do is we find the money to fund the policy to pay for their exit strategy, and then infinite banking shows them how to access the cash value to run and grow their business. And now it's just like it's a closed system. It's a contained system, and they're just growing their business and growing their cash value, and then growing more of their business and more of their cash value, and it just keeps multiplying from there.
That's great. And this may be too in the weeds of a question, but let's say you're borrowing money and you're paying back your policy at, I think I expect it needs to be somewhere around a market rate. But, let's say in today's market, you could pay yourself an 8% or 9% interest rate if you want. Do you know if that's tax deductible for someone who's, say, in New York at a 50% tax bracket, and you can, feed it into your life insurance policy, and now you're growing it at, A, at 8%, but B, is it an expense?
Well, my understanding, and I'm not a tax person, but my understanding is that the interest payable to the insurance company is not deductible. However, you could loan money to your business. So, Jack, if you have a policy and you borrow against that policy, and then you turn around, and let's say the insurance company's charging you 5.5% interest, you can take, let's say, a $20,000 loan to buy a vehicle, and then you turn around and you personally loan $20,000 to your business. What's the going rate on a business loan today? 8.5%, 9%, 9.5%?
Yeah.
So you could charge your business 9.5%. The business will get to deduct that interest, just as they would if the business borrowed money from Bank of America or Citibank. True?
Absolutely.
But now you're going to have to pick up that interest expense by your business as interest income to you. Now, in and of itself, that should be a wash, especially if you're a sub S. But now you just got that money out of the business, and that, you have to pay tax on, let's say, 9% of interest that you earned. Then you turn around, you put 5.5% back into the policy, principal and interest, to pay back the policy loan. And that's really what you want to do. You want to pay back that loan so there's money available for the next time your business needs money. And guess what? Your business will need money.
Yeah, absolutely. On top of the fact that, I love it. The interest, you get a write-off for the business, paying the interest out. You get to depreciate the purchase most likely. And, I can't help nerding out on tax efficiency.
Yeah.
So, great. We're going to start wrapping things up here. What are some final takeaways, for people that are curious, interested? I know you've got the ebook, which we'll definitely put in the show notes. But let's sort of just turn it over to you for kind of parting words or final tips.
Well, we see the impact that this our whole process is having on people. And we have a 4-step process. There's no cost or obligation, and I'm not selling that. Listen, if you don't think you're making the most efficient use of your money, or if you're making good income and you're frustrated, then there's probably a reason why. But our process is real simple. It's 4 steps. Number 1, we identify where you're giving up control of your money. Number 2, it's the hardest step in our process. You got to stop doing what you've been doing. You got to stop doing what the financial gurus or your neighbor or your coworker is doing. Number 3, you got to save in an area that you own and control. And number 4, that's where the magic happens, when you start to borrow against your own money and pay interest back to yourself or back to an entity that you own and control. But we call that the financial golf swing. And here's how we differ from other quote unquote financial advisors. All the other financial advisors want to know what you got. So they basically say, show me what you got. Jack, show me your golf clubs. What you got stinks. Your golf clubs stink. Come to my pro shop. I'll sell you a new set of golf clubs. That's a synopsis of the way the financial services industry works. Our philosophy is a little bit different, and Julie could tell you this as well. What we say is, I don't know if we could help you, but there's only one way to find out. Let us see how you're using your money. So let's go down to the practice range and take a look at your swing. Let's see how you're using your money. And if there are some adjustments that need to be made, if you have holes in your bucket, we'll plug the holes or adjust your swing before we make a recommendation. Because it doesn't make sense to go out and buy a product if you're still hemorrhaging cash.
That's great stuff, and I can knowing both of you personally, and spent a little bit more time with Julie and Nicole at various events, but really enjoyed getting to know you both. I think you've got a great just attitude of abundance of sharing information, and would certainly encourage anybody to reach out, and we'll put contact information in the show notes.
Great. Thanks, Jack. We really appreciate you having us on and at least providing information, like you said, and people get to make a choice at that point.
Absolutely. So thanks again. I'm sure we can do another episode at some point. You're both a wealth of knowledge, and would like to just remind our guests to please, or our audience to please like and subscribe, iTunes, Spotify, YouTube channel for JCAM Investments, and connect with us on all major social media. And real quick before we go, Tim and Julie, just we'll put it in the show notes, but the website and best way to reach out.
Sure. It's wealthlinkventures.com/JKAM. Again, that's wealthlinkventures.com, JKAM/JKAM.
Yeah, and you could reach me through that same link. Jack, thanks so much for having us on. It's really, I can't believe how fast this time went.
Yeah, absolutely. That's part of the fun of doing podcasts, just having great conversations, and time does fly. We'll likely make this a 2-part episode, so this is probably the end of part 2 at this point. So thanks again, and I'm sure we'll be both connecting soon.
Awesome.
Sounds good.
Thank you, Jack.
Thanks, Jack.
Thank you.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.